Two index heavyweights are eyeing for a consolidation into a single entity. You guessed it right. We are discussing about HDFC Bank and HDFC Limited mega merger. Since the announcement on 4th April this year, investors are inquisitive about the outcome of this merger and the impact it will have on both the entities. Both stocks were up almost 10% just after the announcement, indicating that the market participants have welcomed this event with a smile. Welcome to MoneyWorks4me podcast, where we discuss market events, sector updates, and much more. Today we have with us our equity analyst, Mr. Hrishikesh Bise, and we are going to try to uncover the nitty-gritties of this event for retail investors. Disclaimer: HDFC Bank and HDFC Limited are our portfolio companies for a long time, and our clients and employees might be owning either or both of the stocks in their portfolios. With that, let's start our today's podcast. Welcome Hrishikesh, hope you are doing well.
Thank you, Atharva.
So Hrishikesh, HDFC Bank and HDFC Limited announced that they have received the board approval for amalgamation of the two entities. And according to the merger ratio, HDFC Limited shareholders will get 42 shares of HDFC Bank for 25 shares of HDFC Limited.
Yeah, correct.
The record date is yet to be announced and the transaction is expected to be completed within 14 to 18 months. So how do you see this event as an equity analyst perspective, and why is it happening right now?
So there are two reasons to it. Firstly, the merger fulfills the implicit RBI policy of not allowing a bank to be owned by an NBFC or a housing finance company and having its lending business housed mainly in a bank. So they wanted to have everything under one roof, under one bank. That's the first reason. Secondly, in the past, when compared to banks, NBFCs have enjoyed lesser regulations. But however, in the last 3 years, especially after the IL&FS crisis, which led to the liquidity crunch, the norms and regulations have become very stricter for NBFCs. So for instance, NBFCs would report NPA only if no single installment has been paid in 6 months. And even if single installment was paid within those 6 months, that account would not be termed as an NPA. But recently the RBI changed these norms and the 6 months have been changed to 3 months. Therefore, there is no specific regulatory advantage that a large housing NBFC like HDFC Limited would enjoy by remaining an NBFC. Therefore, merging with a bank makes sense.
Correct. That's quite precise, Hrishikesh. Thanks for that. But the thing is that when two entities consolidate, okay, their assets and liabilities gets also merged. So how do you see that this merger? What effect do you see that this merger would be having on the asset base of these two entities?
So, talking of two entities, anyways, the HDFC Limited is going to be merged with the HDFC Bank. So, what we are going to stare at after the merger is the asset base of HDFC Bank. So, let's talk of HDFC Bank's loan book. So, the merger will increase the share of mortgages in HDFC Bank's loan book. So, HDFC Bank has not had material portion of home loans and mortgages on its loan book. So the default rates for the home loans are generally lower, which will therefore improve the overall asset quality of HDFC Bank's asset. But then HDFC for HDFC Bank, a higher share of mortgage business, which is about 33%, could be margin dilutive because generally the yields on the home loans is lower as compared to the other like personal loans or auto loans. But risk-adjusted margins will still be healthy, and also the tenor of the loan book itself will increase because the mortgages are generally high-term loans.
Yes, correct. So Hrishikesh, the thing is that as investors know that when a merger or acquisition happens, there are always talks about the outcomes or the possible synergies that the two entities or the 2 or 3 entities might be able to achieve.
Correct.
So what kind of synergies do we see these two entities enjoying after this merger?
So there are quite a few pretty obvious synergies that would happen. Let's talk about one by one. Let's talk of the increased cross-selling opportunities that HDFC Bank would get. So the merger strategically fits HDFC Bank's product basket. So the home loans, like I just said, they are long tenure loans. So this provides banks the opportunity to cross-sell unsecured, low tenor and profitable credit to the customers during the loan repayment cycle.
Yeah.
So they onboard a lot of customers on their in their ecosystem, and those customers would then be open for the avenues will be opened up for the cross-selling the other products to those customers, and those customers will be with you for a very long time.
Certainly, yeah.
So this will drive up the lifetime value of the customers. So just to give a data point, nearly 70% of HDFC banks, 6.8 crores, do not have housing loans.
Oh.
So thus the merger will provide an opportunity to cross-sell mortgage loans, while HDFC Limited customers will be offered other banking products. HDFC Bank's cost advantage will make the housing loan business much more competitive due to rising dominance of the banks in the segment. So that there comes the second benefit. So the cost of borrowing to the banks is generally lower than NBFCs. So NBFCs have to rely on the wholesale fund raising from banks or markets, both which are relatively costly as compared to banks' cost of funds. So banks on the other hand have CASA ratio, which is the lowest cost of borrowing because they hardly pay anything to the current account saving account holders. So the merger augments the ability to raise big ticket loans, especially at a time when capital investment in the country is picking up. So you have a larger balance sheet, and so your strength automatically increases. Thirdly, the benefits that coming from HDFC's expertise. So HDFC Limited has had an expertise in the real estate space, and it is known for efficient processing of loans, which has enabled a favorable cost to income ratio to HDFC Limited so far. So for HDFC business of mortgages, lower cost of fund will be made available because of HDFC Bank, and the bank will have access to efficient mortgage origination and loan servicing processes of HDFC Limited.
Yes, that was very well explained, Rishikesh, because the thing is that synergies and mergers are all about the mutual benefit.
Yeah.
Where one entity should benefit from the advantages or the competitive advantages of the other entity, and vice versa. That was very well put. But the thing is that there will always be some challenges. So what challenges do you see in this merger as well? Because not everything is as rosy as it might look. There might be some challenges inherent in the overall merger process, or the acquisition of customers, in approvals from the shareholders, and even the approval from the board as well, and the regulatory formalities. What do you see on the challenges front?
So on the challenges front, I see most of it is towards regulatory challenges. So first obvious challenge is that the merger is subject to the regulatory approval from RBI or IRDA, CCI, SEBI and stock exchanges. So RBI advocates the holding company structure for non-lending businesses. So if this structure particularly, which the current existing structure is not approved, the companies will have to reconsider the scheme of arrangement. So right now most of the things are factored in by keeping in certain scheme of arrangement, but that could again change because of the regulatory requirements. So that is one risk. Secondly, the SLR and CRR requirement. So the banks are required to follow certain regulatory commitments such as statutory liquidity ratio and cash reserve ratio. So SLR is required to be 18% of net demand and time liabilities, while CRR is required to be 4% of net demand and time liabilities. So this merger will require higher appropriation for SLR and CRR, which would lead to impact on the return on assets, because these SLR and CRR, the money kept under SLR and CRR, it is mostly low yielding securities. So that would again impact on the overall ROAs, and for quite some time the ROAs would remain a bit depressed.
Okay.
And then thirdly, one more thing, like I just mentioned in the previous question also, on the margins. So the merger may lower the net interest margins due to inculcation of mortgages in the HDFC Bank's loan book. So mortgages, just like I mentioned, generally have a lower default rates and lower margins also, because of its secured nature.
Yes.
So you don't have a lot of people defaulting on the home loans, and the interest rate on the home loan also is very low. But then given the housing cycle in India is poised for uptake, the growth in housing loan can compensate for the lower NIMs.
Yes,
so that risk pretty much could be could be cancelled out.
Right. So as you actually mentioned that the housing cycle is on the uptake, and we have been participating in various names that directly cater to the housing industry, be it building material space or cement and housing finance.
And we have been pretty early in those, like into building material especially.
So I guess that diversification could negate the effects of this one particular risk from lower margin products of the HDFC Limited. That's great. That's good. So, but what would be the short-term impact on the stock price? That's the most. This is the most repeated question that our subscribers have asked us. That what in the short term the impact would be on the price?
Yeah. So firstly, this is just about the price movement. I mean, I'm not talking about the business here, but so there could be some factor that could lead to short-term volatility in the stock price of the entities. So HDFC Limited forms about 6% of the MSCI India index, and HDFC Bank is not a part of the index, MSCI index. So HDFC Limited will cease to be the part of MSCI index once this merger happens, because then HDFC Limited is going to be a part of HDFC Bank. So FIIs may reduce their exposure to HDFC Limited in a steady manner. Okay. But on the other hand, DIIs on an aggregate have been underexposed to HDFC Limited as compared to the benchmark. And one reason of that is the tapered down growth rate of HDFC Limited. So that's why most of the mutual funds have been relatively underweight to the stock. So now post the merger, they may want to increase their exposure to it. So there would be a tussle between DIIs and FIIs, and there would be a buying from one side and selling from one side. So due to all these reasons, the stock may see some volatility in the medium term till this things settle down.
Correct. So Rishikesh, the thing is that our subscribers are getting their advice on asset allocation and rebalancing from our solutions like Superstars and Omega. But people who are listening to our talk right now, they might not be our subscribers yet. Okay, they might be exploring our site. They might be just listeners of this podcast. But they might be having these two stocks in their portfolio, and they might be having under-allocated or over-allocated depending on how their conviction was on their stock. But what anything you want to suggest to our listeners on the asset allocation part? Since most investors definitely, as I said, would be having these two companies in their portfolios.
Yeah, correct. So, firstly, coming out with respect to the allocation, we do not see any change that is required in the allocation in both these entities. So, looking at the future prospects of a merged bank, the positive impacts mentioned that during the talks, they majorly surpass the negatives. I mean, the risk that we talked about. I would suggest that we won't mind holding 7% allocation of a merged HDFC Bank in our portfolio, core portfolio specifically.
Yes.
So our recommendation would be to keep the allocation as it is. But if there's some material change that happens in the structure or into the organization, and that leads to any change in the future prospects, then we might recommend reducing the allocation. But right now that doesn't seem to be the case, given the fact that at the current juncture the things look fine, and we would recommend the status quo to the existing allocation.
Okay, that was great, Rishikesh. That was really an insightful discussion. Even a lot of my doubts, maybe listeners' doubts have been clarified on the positives, negatives, outcomes, and the future aspects of this merger. Okay, thanks for time, Rishikesh.
Thank you, Athurva.
Yes, and secondly, on the forward listeners, MoneyWorks4me is a SEBI-registered investment advisor. We advise our clients on long-term portfolio building. Where we build high-quality stocks portfolio for our clients by doing this advice we provide to our subscribers through our two solutions, which are predominantly Superstars and Omega. Where Superstars is our do-it-yourself product, which is more accepted and welcomed by do-it-yourself investors who are more inclined towards research, doing their research on their own and building a direct stocks portfolio. On the other hand, where we have the Omega, which is a portfolio advisory solution, where we charge almost close to a direct mutual fund plan, which is very competitive in the entire industry and which is mostly welcomed by business owners, entrepreneurs, professionals at high level management who do not have the time to dedicate to do it yourself investing and all the what we can say the responsibilities that come with managing a portfolio. They subscribe to our Omega portfolio advisory solution. We have them in our on the website. You can check the our solutions section on your in your account or on our website and get to know more about our plans, and you can schedule a call with our investment counselors, discuss with them your requirements, your challenges, and maybe get a right fit for your requirements from a solutions point of view. Thank you for attending this podcast. Rishikesh and Atharva signing out. Thank you. Have a great day.